Okay, so in this video, I'm going to talk a little bit about the cost of debt. So if the three sources of capital that a firm has are debt, preferred, and common, so we got debt, preferred, and common equity, then basically, let's start with the cost of debt. So cost of debt. Cost of debt is going to be interest, which I'm going to denote by R subscript D, so RD. Now, as I talked about in a prior video, what we care about is the marginal cost of debt. So I don't care about the coupon rate from years ago. I don't care about what the yield to maturity was years ago. What I care about is what's the cost now. So if I borrowed an extra dollar today, what would the cost be? So that would be the appropriate cost of debt for me to factor in. Now, to find that, basically what you're going to look at is the yield to maturity for the company's current debt today, possibly yield to worst. So let me define yield to worst for a moment. Some bonds are callable. So if bonds are callable, that means that the company can actually pay them off early. And so some bonds are actually callable at certain points. So if, for instance, let's say it was a 30-year bond, after the first 10 years, the company could pay it off. Then if maybe another 10 years goes by, or 5 years goes by, they can pay it off at year 15. Maybe another 5 years, they can pay it off year 20. Then another 5 years, they can pay it off year 25. And then year 30 rolls around, well, it's coming due, they're paying it off. So there are several different points in my example at which the company could pay it off. So you can calculate what's called a yield to call for the investor, which would be basically if the company paid it off at those earlier points, what would the yield be for the investor? And you can calculate off if they paid it off at year 10, if they paid it off early at year 15, and so forth. You'd have all these different yield to call values and also the yield to maturity if the company just paid it off at maturity. And the yield to worst would be, we're going to look at the lowest rate of the bunch. And because that would be the worst scenario for the investors, the yield to worst. So that's probably going to be reflecting more of the borrowing cost of the market today, basically. So yield to maturity, if you got a bunch of callable debt, possibly yield to worst. And if the company had a lot of different types of bonds, generally what you'd focus on is probably the longer term bonds. So think more, bonds that have got another 20 or 30 years to go. You try to focus on more long term, not something that's coming due in the next year, because that's really at this point, even though it was issued on a long term basis, it's going to be subject more to some of the short term kind of factors because it's only due in a year. So you're going to be looking at more of the long term debt, things that are out there for quite a while yet. So possibly average several yield to maturities or yield to worst values for kind of appropriate maturities, generally skewing towards the longer maturities to try to find the true long-term borrowing cost here. Now, significantly, interest is tax deductible, possibly within some limits. That might vary depending on what tax laws get passed, things like that. But basically, the idea is for every dollar that the company pays in interest, it reduces the taxable income by $1, which means that less is paid to the federal government. So that means since for every dollar I pay in interest, I pay less to the federal government, then really the true economic cost of this debt to me is not that stated yield to maturity or yield to worst. I need to factor in basically that I save money on taxes here. And the way to do that is to calculate the after-tax cost of debt. And to calculate the after-tax cost of debt, you take RD times 1 minus T, where T is the tax rate. So if T was 20%, I would put 0.2 here for T. So I'd have 1 minus 0.2, which would be 0.8. I would take the 0.8 times whatever that yield to maturity or yield to worst was, the RD value, and together that RD times 1 minus T, whatever the end result of that calculation was, that would be my after-tax cost of debt. Now, theoretically, as a technical note here, the marginal cost of debt would technically involve issuing some more debt, which technically involves flotation costs. Flotation costs are the costs you have to pay to get a security issued, like issuing shares of stock or issuing bonds. And generally, you have to work with investment banks and things like that to do this efficiently. Investment banks don't work for free. So they charge fees, and those fees are basically what's going on with the flotation costs. So technically, if I was issuing $1 of debt, I would have flotation costs. But often in the cases of debt, the flotation costs are generally assumed to be minor enough relative to the amount of money that's being raised. That's often ignored, and we just don't talk about it much. But technically, that is something that you'd want to consider if you're looking at the cost of debt is how much do we actually have to pay in terms of flotation costs to issue this dollar of debt, because we are looking at the marginal cost of debt, which is if I issue one more dollar, what's the cost? But if we ignore it, then basically we can focus on that yield to maturity, yield to worst, look at the tax rate, and I can look at the after-tax cost of debt. And then I can use that when trying to calculate what my overall cost of capital is. Okay, hopefully this video has been helpful. Thank you so much for watching and have a great day.